Nancy, thanks very much for joining the conversation. Wonderful to see you again. What is your take on where we are in terms of the macro story? I want to get your take on the potential of a recession and how sharp a slowdown in growth you are expecting.
Well, we are at the early stages of a very significant synchronized global recession. It's going to be a global recession pulling down Eurozone in particular. It looks like China GDP in the second quarter could also be negative. Now, we think the United States could not go into a recession. We have still plus 1% GDP for the U.S. this year, but that's still a very significant slowdown from roughly 6 last year to 1. 1 will feel very, very weak. We had a similar situation back in 2015. There were fears of a recession in 16. You didn't get it, in part because the backbone of the United States is pretty healthy, which we still think is the case. But nonetheless, outside of the United States, indeed, you do get a recession led by the Eurozone, given what's going on with oil prices and global interest rates.
Yeah, Nancy, I want to show you this graphic we have of the commercial ships that are stalled in Asia. Shanghai's lockdowns having a ripple effect on the global supply chain. Volunteers, government workers blocking off small streets and entrances with metal barriers. This China zero COVID approach has commercial cargo vessels stalled in the water. What are you thinking about in terms of this supply chain nightmare and its effect on all of this?
So first, obviously, for China, this is a pretty harsh medicine, so to speak, shutting down the economy, potentially, as you mentioned earlier, maybe even Beijing. So the Chinese economy is a major headwind to global growth. As far as the supply chain is concerned, there's a little bit of some incremental good news, which is this isn't Christmas. When we had the Delta variant last summer, you were headed into the shipping season for Christmas. It obviously stopped. That prevented goods getting into stores and created a surge in inflation. Right now, it's a very different story. Inventories are actually egregiously high for many companies. We're hearing that anecdotally, the furniture industry in particular, but now we're starting to hear it maybe also within the used car industry, also home improvement. So right now, inventories are actually very elevated. We would call it, we're moving into an involuntary inventory accumulation. So quite frankly, I'm not sure we need any more stuff from China right now. I don't think it's as big of a headwind to the U.S. economy as it was last summer and fall. Because of a very, very different selling season, i.e. it's not Christmas, and we don't, quite frankly, need any more stuff coming into our shores. It could incrementally hold back some sales for certain companies, in particular the tech side of the equation, but we think it's pretty de minimis compared to what it was last summer, at least for the U.S. economy.
Nancy, I'm looking at your most recent weekly narrative, and you write, bursting bubble hitting prices, confidence, and EPS. This is a really important point, Nancy. We're talking about 40-year high inflation, but you're talking about things breaking, perhaps sending prices lower. You even mentioned Netflix. Walk us through it, Nancy. What are you saying here?
So a year ago, obviously, consumers had a ton of money. They pulled forward demand. They bought a lot of stuff. They streamed a lot of stuff. That's over. And particularly for things like furniture and used cars and electronics, we don't need any more stuff. And so you pulled forward demand. Obviously, at the time, as we just said, there was also a shortage of goods. And that shot prices obviously dramatically higher with the CPI up over 8%. That's old news. And I would argue the market is figuring this out. Certainly companies are telling us that this is happening, from Netflix to Restoration Hardware to Carvana. You're now clearly seeing consumers are declining spending on goods, with inventories now elevated in many cases, maybe not all, but in many cases. And we expect actually goods deflation. We've seen used car prices decline 6% just in a few months. We've been expecting used car prices to decline about 13%. I think that's too low. That's too high. They're going to drop even more than that. Again, you're down 6% in used car prices just in a couple of months. And so we think it's going to spread from industry. Netflix did also announce that they're probably going to be cutting prices. And so, yeah, I think we're going to have significant goods deflation. On one hand, that's positive in that you're going to send Obviously, CPI significantly lower over the next year. But on the other hand, it's not going to be pretty in that it's going to affect companies' earnings through lower earnings via weaker demand for products and also declining prices. So good news is lower inflation is coming. Bad news is it'll be bad news for company earnings.
Yeah, which is what I'm leading to now. Here we are approaching the biggest week yet. 49% of the S&P 500 will report this week. And in this report, you write business confidence clearly eroding. Give us your sense of what you've seen so far in the earnings story and what we could see this week. We've got some of the most highly valued companies taking the test this week. Apple, Amazon, Google, Microsoft. What do you think we'll see from the earnings period? And guidance.
Well, if any of those companies benefited from the stay-at-home bubble, they're vulnerable to, if not disappointment in 1Q, disappointment in 2Q. We think on a year-over-year basis, earnings slow sharply. By the fourth quarter, they're actually going to be negative on a year-over-year basis to the tune of about -4%. So even though GDP doesn't turn negative, earnings indeed do. Again, because demand was pulled forward at an unsustainable pace last year. And prices rose, which was due to the supply-demand imbalance that we had. If anything here in 2022, it's going to be just the opposite. Just as companies surprised on the upside last year, they're going to surprise on the downside this year. So just be careful. If companies had double-digit unsustainable revenue growth last year, that's very, very vulnerable. You are also now facing fiscal drag, where you had fiscal stimulus last year, propelling that consumer spending. Right now, consumer incomes are actually declining on a year-over-year basis and even sequentially, and that is obviously a big headwind to many of these. And if revenues are slowing dramatically for companies, this is not just a consumer story anymore. If revenues are slowing sharply, which they are, nominal revenues last year were up about 10 to 15% on a year-over-year basis. Look at a chart that's unsustainably high. It was fueled by this massive stimulus that was put in the consumer's hand. Again, that's now totally reversed with incomes now declining, crushing revenue growth to the probably low single digits. And that's going to be a big headwind, obviously, to earnings. And many of these companies have increased costs at the same time. They were watching the trucking industry very closely, which has also seen a sharp decline in unit activity, not revenues, but unit activity. And we think that space is very, very vulnerable to some weakness given the surge you've had in wages.
Yeah, it's a great point. And you've been making this point on this program, by the way, for months now. You've been talking about this slow economy, and you write that this has been baked in the cake way before Putin, way before Powell, and you're still getting pushback. I'm certainly not going to push back because you've been spot on for years, Nancy. Give us your take on the Fed. 50 basis points in May. We're going to get a couple of 50 basis points hikes. What do you see for the Federal Reserve string of rate hikes in the coming months?
Yeah, my partner, Roberto Perli, does think we see 50 basis points in early May and probably another 50 in the summer. Then it's not so clear. The economy globally is clearly at a negative tipping point. You're starting to see signs of financial strains. Classically, every Fed tightening cycle ends with one of the three things, either a financial crisis, as we had in December of 1994, either a crisis and a recession, as we had in 2008, and or just a recession. And so we're expecting things to start to crack from a financial market perspective. Weak links always crack first. We're watching the EM space very, very closely. But there could also be problems here in the United States. The Fed is tightening into what has already been a very, very significant global tightening cycle with global short rates up dramatically. And so we don't think the Fed is going to meet market expectations.
All right. Always a fantastic conversation, Nancy. We so appreciate your insights and your wonderful work. Thank you for being here this morning. Nancy Lazar.
Thank you very much.
Lots of predictions there. We'll see you soon, Nancy.